Okay, so let's get more perspective. Kathryn Rooney Vera, StoneX Group Chief Market Strategist, joining us to continue the conversation. Kathryn, given the selling we're now seeing after the big run-up, how do you anticipate things playing out here in December?
Rally, so it could be volatile, but I would expect there to be some positive momentum going into year end. My biggest concern is what happens next year. And I think that, and I've said this on Bloomberg quite a bit, is that the markets are discounting with a very close to certainty the potential for the ultimate Goldilocks scenario. And what I've been advising our clients, John and Alex, is to take the opposite bet, look at options with the volatility index historically low, and price and really protect your positions going into 2024, because there's a good chance, maybe not a majority chance, but there's a very good chance that we don't nail that Goldilocks scenario where unemployment doesn't move higher, where the economy continues robust and inflation drops to the 2% rate.
And I guess as we monitor the data points after market participants have place their short-term bets, the mood of the bond market, what happens with yields there is, I guess, another determining factor, since what had happened to yields recently was one of the fuels for the stock market rally.
Yes, and what we're seeing now is there's a lot of bets, one-way bets on the Fed cutting rates about 125 basis points next year, which I think is unrealistic in the semblance of a Goldilocks scenario, in a soft landing scenario. Probably if the Fed cuts 125 basis points to 250, as some shops are calling for, that's because we're in a recession. So, be careful what you wish for, because as bond yields decline, if they're declining because of what we expect to occur, which is a rollover in the U.S. consumer in a consumption-based economy, then that's not going to be positive for equities. So a drop lower in yields, if it's because of a slowdown in the economy, is not going to be bullish for earnings.
Yeah, that's the confusing part, which it feels like why Tony Dwyer is saying chillax felt kind of good, because it's like if you're cutting to normalize is different between easing, right? So cutting versus easing is, I feel like, the tension that we're all getting to. And then what happens in that moment? Like, go ahead and be bullish until you have to cut to ease, or the flip?
I think what makes sense is to act counterintuitively, which is right now markets are going up so fantastically. Let's play the opposite. Put options are cheap. Buying calls, that's pretty cheap. Let's not, pursue the high flyers that are probably going to drop next year if the Fed doesn't cut as much as the market is expecting. And if it does, it's because of something very negative. So what I'm recommending to our clients is take the opportunity that the market is presenting us now to position ourselves defensively. It makes sense to me, Alex. I think that treasuries could even go lower in terms of yield next year because we're in recession. I think a 10-year treasury that broke 5% at that point for me was a clear buy signal. I think even T-bills, where you can get 5.5% yield, makes sense. Cash equivalent paper makes sense. It's not very enriching for the banks to say this, but when you look at the equity risk premium and you compare the S&P 500 versus the 2-year treasury bill, that out earns. The 2-year treasury bill is better in terms of yield than the S&P 500. And you compare that to the high yield market or investment grade market. To me, it says that it's time to overweight fixed income, and I would say in the short end.
What about gold? I mentioned hit a record high. Then some say maybe it's a canary in the coal mine and we're kind of getting out of that. What do you do with gold right now?
I think if gold continues this move lower, then it's an opportunity to accumulate. I have liked gold for some time. It's been a winning call. Current levels after this boom that we saw on Friday, Alex, I don't think are opportune to enter. But if we continue to see a leg lower, I think gold makes sense. I think gold makes sense. I think defensive sectors and equities make sense. Overweight fixed income makes sense. And protecting your positions, not wholesale selling of equities, but at a minimum protect those positions with options and with a readjustment towards more defensive sectors that outperform in both stagflation and recession, both of which I think are a higher probability than currently discounted in the market.
And then, Kathryn, if corporate profits can hold up into next year, does that change the possible narrative if people think stocks have gone too far, too fast? policy not quite there yet. What if companies have been preparing for more questions about that headed into next year? Is it possible that they could be ready to counter any views that they're going to be under pressure, because a lot of people saying we're now kind of getting some momentum on the earnings side?
Yeah, and that's a very good point, John. And if one thinks that we are not entering an economic slowdown, but perhaps a reacceleration and recession is not on the horizon, and we're going from where we were in 2023 to something even a bigger boom in terms of economic activity, then I buy that argument. Corporate profitability continues to expand. But I suspect that corporate margins are going to come under pressure under the triple whammy of what we're still seeing, which is high labor costs, high real rates, right? Mm-hmm. High real rates with the Fed still on hold, and energy costs that, yes, have come down, but more likely than not are going to rise higher. So that's a triple whammy. I think probably what's going to happen here is that to maintain margins, John, corporations are going to stop the job hoarding and reverse the job hoarding, which means that they're going to start shedding jobs to prop up those margins. And if that's the case, then I think that's a nail in the coffin to the U.S. consumer, which itself faces some headwinds, high real rates, complete exhaustion of those nice checks during the pandemic. So liquidity is drying up, and they're experiencing ongoing inflation with high real rates. So I think it's going to be a complicated scenario, and I think that the headwinds for the economy next year are woefully underpriced into market sentiment right now.
Okay, for Kathryn, bad news is bad news. Do you think that Friday's jobs number, bad news, good news, or good news, bad news?
Yeah, I think that if the jobs number disappoints, then it's going to probably be good news, because the market is discounting a Fed that can land this thing perfectly without any hiccups. So I think the market is rooting for the economy or jobs to slow down in terms of the growth there.
All right, Kathryn, good to see you. Thank you so much, Kathryn Rooney Vera, StoneX Group Chief Market Strategist. Thanks a lot.